Have you ever noticed that the stock market seems to have a personality? One year, everyone believes the future is limitless. Headlines celebrate record highs, investors feel like geniuses, and buying almost anything seems to work. Then, almost overnight, confidence disappears, fear takes over, prices collapse, and the very same people who couldn't stop buying suddenly can't wait to sell. Howard Marks has spent decades studying this pattern, and his conclusion is surprisingly simple. Markets don't move in straight lines, they move in cycles, and those cycles are driven more by human psychology than by numbers. If you've ever bought a stock because everyone else was talking about it, or sold an investment simply because the market was falling, you're not alone. Nearly every investor has felt the pull of greed during good times and the weight of fear during bad times. The truth is, investing isn't just a battle against the market, it's a battle against our own emotions. Howard Marks often reminds us that the biggest investing mistakes rarely come from a lack of intelligence, they come from emotional decision-making. When prices keep rising, people begin to believe that risk has disappeared. Confidence turns into overconfidence, and eventually into complacency. Investors stop asking whether an asset is worth its price. They only ask one question: how much higher can it go? That's the dangerous stage of every bull market. Optimism becomes contagious. Friends start talking about easy profits. Financial news becomes overwhelmingly positive. Social media fills with success stories. The crowd feels unstoppable. But Marx warns that when everyone agrees the future can only get better, that's often when risk is at its highest, even if it feels safest. History has shown this repeatedly. During the dot-com bubble, investors poured money into internet companies with little regard for profits because everyone believed technology stocks could only rise. In 2008, many believed housing prices would never fall significantly. More recently, during the rapid recovery after the COVID-19 market crash, optimism returned so quickly that many forgot how frightening those earlier weeks had felt. Different events, different decades, but the same psychology. Then comes the other side of the cycle. Fear replaces confidence. Investors who were once excited become desperate to escape. Great businesses are sold alongside weak ones because emotions overpower logic. Howard Marks believes this is where extraordinary opportunities often appear, not because the economy is perfect, but because people allow fear to push prices below their true value. This is why understanding market cycles is so powerful. You don't need to predict the exact top or bottom. In fact, Marx argues that very few people can. Instead, you learn to recognize the emotional environment. When greed dominates, become more cautious. When fear dominates, become more thoughtful instead of panicking. Successful investing isn't about always being right. It's about staying rational when everyone else is becoming emotional. That's easier said than done, but it's the habit that separates disciplined investors from the crowd. The next time the market is soaring and everyone believes wealth comes easily, remember that confidence can quietly become dangerous. And when the headlines are filled with panic and uncertainty, remember that fear often hides tomorrow's opportunities. As Howard Marks teaches, the greatest advantage in investing isn't having more information, it's having better emotional discipline. If this perspective changed the way you think about investing, subscribe for more famous investing lessons, share your thoughts below, and remember, mastering your emotions may be the most profitable investment you'll ever make.